value they have in pushing back on the numbers, asking their direct reports, who then ask their direct reports, who then ask their direct reports to clarify or magnify a point that was in the certification or in the numbers coming up, in which everybody all the way through has a much better sense about how the business is performing. That is to say, internal controls is not about protecting fraud. It can go a long way toward preventing frauds, but internal controls are really the key point, the threshold point for making sure that the directions from the top are being followed by those at the bottom, and that the organization is going in the direction and carrying out the business plans and the policies of those. So the certifications are really an amplification of something that's been a major point of for example, auditing practice. My first profession was that of being an auditor, and we always knew that when we went out to do an audit, the very first thing we were supposed to do was to evaluate internal controls. Because if you had weaknesses in internal controls, it may give rise to a substantial qualification on what your opinion could say or could not say. What we found in the time since then, the almost 4 decades, I must say, in fact, it was 4 decades that intervened there, was that internal controls went by the boards, that auditors did pay less and less attention. And that is why we've had this firestorm of protest when Congress in the United States enacted Sarbanes-Oxley in July of 2002, that one of the requirements there was to mandate that the senior executives would annually evaluate their firm's internal controls and were required to identify any material weaknesses in internal controls. And then Sarbanes-Oxley mandated that the auditors, the outside auditors, would then evaluate management's evaluation, attest to management's evaluation. Now, we know that that was a very expensive process. There's howls and screams, and that provision of Sarbanes-Oxley, 404 of Sarbanes-Oxley, mandating the annual certification function for internal controls, became the poster child for overregulation of capital markets, the death of American capital markets, in fact, the death of America. I mean, you get to choose any of those. Some of the criticisms were well placed. The initial rules for guiding internal controls were badly articulated by the governing body. They were badly executed by the accounting profession. The accounting profession was ill prepared to carry out evaluations for internal controls because, at least in America, I'm not sure that's true elsewhere, they hadn't done it for 25 years, so it's like learning to ride a bicycle the first time. They spend a lot of time falling off. But more importantly, there was a hell of a lot of deferred maintenance in the reporting system, and as a result of that, we had what? We had record-breaking years for the first 3 years of restatements, where you had restatements of earnings in the 20 to 30 for the 6,000 reporting companies in America, 20 to 30 number in 99 and 2000. Suddenly it jumped into the hundreds, and we even exceeded 1,000 in 2004 because of, guess what? You went back, evaluated internal controls, you found weaknesses, and as you started digging down, guess what you found? You found that, whoops, we made a few mistakes. Whoops, we made a lot of mistakes, okay? Whoops, we better correct the mistakes. Restatements are now down remarkably, and the costs for audits have leveled off, and we've gotten past this. Now, we're waiting for the second shoe to drop because there was a phase-in, not quite the phase-in it needed to be, but we've only been doing the 404 requirement for accelerated reporting apartment companies, those with a market cap, a market float of $75 million or more. We're waiting to see what's going to happen with the rollout for other issuers at that point. The point here is that trustworthy reporting, everybody agrees to it. And there's no free lunch here. It's expensive. If you're an executive in a public company, you have a stake in that. The key to making this process work is not just a committed CEO. The tone at the top is absolutely important. But that tone needs help and needs support. And so the other innovation that becomes truly important is to make sure that those auditors are independent, that they are individuals who see themselves as professions. And what's that mean to be a member of a profession? Member of a profession, lawyers, auditors come to mind, means that you have public responsibilities. You have responsibilities that transcend your own position. And those public responsibilities are to make sure that the firm is protected from fraud. You make sure that the reports that reach investors are trustworthy and accurate and provide as fair a presentation of the firm's performance and financial position as possible. Investors need that. The CEO needs that. Your suppliers, your customers need that. The people who work in your organization need that. And the community in which your organization functions needs that. Because the health of the capitalistic system depends on the trustworthiness of that system. So the auditors need to be independent. And so what did we learn from the past mistakes? We learned that Enron collapsed, and we knew that its outside auditor was Arthur Andersen, and we knew that its chief engagement partner was a guy named David Duncan, a church-going Republican Christian who had 3 lovely daughters and is sitting in prison as we speak, okay? And the reason that he crossed the line was not a lack of skill. It's a fact of temptation. 75% of his compensation at Enron was based upon his selling of consulting services. Enron wrote a check in the last year of its existence to Arthur Andersen in the amount of $49 million. Less than half of that was for audit services. More than half of that was for consulting services. And David Duncan's compensation was based on cross-selling of audit services. It greatly compromised his position because if David Duncan walked into Ken Lay's office and said to Ken Lay, the CEO at the time, I think you ought to be disclosing these off-balance sheet contingent liabilities that you have in these various special purpose entities. In that case, what would happen is if only David Duncan had a auditor relationship, Ken Lay could say, I'm going to fire you, at which point the auditor says, yes, and if you do, I have to disclose within 48 hours that you're terminating your auditor. I have to disclose that to the SEC. That is a powerful weapon in the hands of an auditor because the minute that there's public notice of a termination of an auditor relationship, the people wearing sunglasses, appear, and it's the FBI, the SEC investigators trying to figure out what the hell's going on here. But Ken Lay could say, thank you very much. We understand what you're saying, and you can kiss off those $27 million of consulting fees, which we're terminating right now, and 3/4 of your salary, but you can continue to be the auditor of this firm, which is not a reportable event. So the ability to turn on the consulting services or turn off the consulting services greatly compromises the independence of the auditor, and that is why you find that there are 7 categories in Sarbanes-Oxley that independent auditors may not engage in for their audit clients, and still be deemed to be auditors of that firm. And quite frankly, that was a little bit of a